Hello and welcome. My name is Ryan Sandler. I'm an economist in the CFPB's Office of Research. Our first session is titled Consumption Dynamics and Household Balance Sheets. We've got 3 excellent papers that are going to be presented, and then we'll have discussion. Following the discussion, we will open it up to questions from the audience. Let's start right off. Our first paper, do we have the slides up? The first paper is The Liquid Hand-to-Mouth, Evidence from Personal Finance Management Software, presented by Michaela Pagel, who is an assistant professor at Columbia Business School.
Hi. Well, I'm honored to be the person who's starting off this conference. I'm really looking forward. The program sounded super interesting. And how can I move the slides? Just clicking here? That's it. Okay, got it. Perfect. So I'm going to talk about the liquid hand-to-mouth, and this is joint work with Anna Olafsen from Copenhagen Business School. Perfect. So what this paper is about, it starts with documenting what we think are almost shockingly robust and homogeneous payday effects. So what do we mean by payday effects? We simply mean that people's spending increases the day they get paid. And we're going to argue because they get paid. And these payday effects, or how people have called it excess sensitivity of consumption, that consumption is too sensitive to income payments relative to kind of what would be predicted in a perfectly rational, forward-looking model, that has been documented at both the micro and the macro level in a bunch of studies since the 80s. And there are some kind of theoretical explanations out there, because it's very important to understand the mechanism for why people's spending increases, in response to kind of perfectly transitory or expected income flows, because it makes fiscal stimulus an effective policy measure. So only when people's spending increases in response to kind of something like a transitory income inflow, like a fiscal stimulus, only then we're going to be able to affect aggregate consumption with something like a fiscal stimulus program. And the theoretical approaches out there typically assume that people have like some illiquid savings device and then some liquid savings device, and because the illiquid savings device pays off a higher return or provides some opportunities to lock consumption away from them, that is why they put a lot of savings into these illiquid devices like houses and cars or illiquid funds. And then they have very low liquid wealth, and that means that they may have a very high marginal propensity to consume out of even perfectly transitory income payments. So what we're going to do is we start off with documenting these spending responses that seem like really robust, like no matter what we do or who we look at. And then we look at what are the liquid wealth holdings of the people. So we observe people's balances and credit limits, and what we find is that less than 3% of individuals have less than 1 day of their average spending left in cash or liquidity the morning of their paychecks. So it seems like a lot of people do have like some cash and liquidity available and wouldn't need to wait for their income payment to kind of go on their spending spree. And then we also find that just the average amount of liquid wealth holdings in consumption, that seems like a little bit higher than what is predicted by these economic models that predict a high margin propensity to consume out of transitory income shocks with low liquid wealth holdings. Now, there's a problem though that even when you have, even when you're not like literally hitting your liquidity constraint, you may be well liquidity constrained, you just know it's out there and you want to keep like, a little bit away from it or have like some buffer until you hit your liquidity constraint. And that makes liquidity constraints very hard to measure, because you have to kind of know when, your buffer is like too kind of like, not large enough or something like that. So we thought very carefully about some ways to maybe measure that people feel liquidity constrained even though they have some liquidity, so they feel they don't have enough of a buffer. And our idea was to look at cash holding responses. And the intuition is that when I have not enough of a liquidity buffer and I get a transitory cash inflow, I should have a very high marginal propensity to hold on to that incoming cash. So this was our idea, how we can detect kind of whether people feel liquidity constrained, and we can look at people and compare their behavior, in kind of low liquidity states relative to their own history of liquidity. Excellent. So the data we use is from a financial aggregation app. So this is one of those apps you can put on your phone, and then you can link all your savings and checking and credit cards accounts to have kind of all of your transactions in one place. And we use data from Iceland from 2011 to 2015. And not only is Iceland the winner of hearts of the last European Championship, but it has also some advantages of when we consider kind of this particular data set. And the most important reason is that Icelandic people almost never use cash. So you're on top of the volcano, and then you want to buy a lollipop, then you can do that by swiping your cards in kind of the vendor's phone, something like that. So less than 1% of our transactions are cash withdrawals. So we think that we have a very thorough picture of all spending. And then what is a concern when you use app data is that you kind of look at these, kind of very tech-savvy, young, rich, well-educated type of population potentially. So in here, we don't have to worry that much about it because the app is not marketed directly to consumers, but marketed through the banks to consumers. So people can sign up for it when they sign up for online banking. So we don't have this particular type of population who, downloads an app and then goes on there and types in all their usernames and passwords and don't mind doing that. And then income and spending are pre-categorized, so we don't have to do word searches or something like that. And we observe overdraft and credit limits. Excellent. These are just some screenshots. So this looks pretty similar to something like mint.com or so. You can also do fun stuff like setting life goals, setting budgeting goals, et cetera, et cetera. You can link all your cards. These are summary statistics, so this is just to convince you that we seem to have a fairly representative population because we compare the spending and income numbers to the representative consumer survey of Statistics Iceland. And here what we find is that in terms of income and spending, when the categories match well, we obtain relatively similar numbers. So this is reassuring. We have something like 45% female users, and that is a little bit different than when you look at US data of this kind. You have typically like between 20 and 30% or so women in that sample, and then like an average income, which is round about my income. Perfect. So the regression we run, we have on the left-hand side, we have the ratio of individualized spending relative to that individual's average daily spending. Then we have payday indicators for the 2 weeks around kind of regular or irregular paydays. And that means that the beta coefficient measures how much spending deviates from average daily spending on the days that people get paid. And we control for a bunch of things like individual fixed effects, day of week fixed effects, week of month fixed effects, year month fixed effects, and holiday numbers. Okay, so what you see here is the 2 weeks around payday. So on the x-axis, it's the 2 weeks around payday. Day 0 is the day people get paid, and then the beta coefficient on the y-axis, and this is from the poorest 10% of our sample and the richest 10% of our sample. So these are the corrupt bankers on the right-hand side. So what we see here is that the poorest 10%, they spend 80% more on the days they get paid, and the richest 10%, they spend 40% more on the days they get paid. And you can see here for the entire population, it goes down within income, and we're also going to see within liquidity, but it doesn't go down to 0. It goes down from like 80% to something like 40%. And we thought a lot about, whether there's like some things in our data that may explain these payday effects. So for example, it could be that, people get paid on the 1st, and that is also when they pay their rent, for example. There would be an explanation for a spike like that. So we rule out all of these things. So for instance, we only look at discretionary spending where people actually swipe their cards generally, and then we also look at irregular income, and we find the same magnitudes. So I have couple of other stories which we looked at. The maybe most important one is that we also look at individuals with uncommon paydays, and then also on spending categories that people don't coordinate on. So we don't only look at restaurants and alcohol, but also on things like groceries or furniture, home improvement, those types of things. And then also, if you worry about endogeneity, so we have some perfectly exogenous variation in the data, and we find the same payday effects there. And maybe the last one, in terms of app usage, so it could be that the app is kind of sending some notifications or something like that, hey, you got paid, and then people are like, hey, great, I'm gonna go out and spend. So this is not what the app does. And then we also have some period before the app got introduced, so we can only look at that. Perfect. You can see here, this is irregular income, exactly the same magnitude, so this is also reassuring that it seems like our fixed effects approach is picking up like some type of residual psychology that seems pretty strong, that when people get money, they somehow feel richer and go out and spend. Perfect. Now we looked at liquid wealth holdings. So what we find here is that a lot of people have a lot of liquidity, and only some 3% or so of our people have less than 1 day of their average spending left in cash or liquidity, which would explain kind of a payday effect. They couldn't do the shopping trip they did 1 day before they got paid. So when I say these people have a lot of cash and liquidity, that still means that, you know, they have a lot of rollover debt, etc. at the same time. So Icelandic people don't look different from Americans in terms of their debt happiness at all. So what we see, for example, for the lowest tercile, they have 38 days of their average spending in rollover debt, but they also have 38 days in liquidity. And then the question is, do we call a person like that liquidity constrained or not? And remember, liquidity constraint means that you have some high future expected income that you cannot collateralize, or like some illiquid savings that you cannot collateralize, right? When we see somebody hitting the liquidity constraint, we know, you know, probably this person wants to borrow more and can't. But when we see people having a lot of space, you know, we don't know whether they just want to keep a buffer until they're liquidity constrained, or, you know, maybe they are not liquidity constrained. Maybe they just borrow, you know, the optimal amount. Maybe they borrow too much because they have an overconsumption problem. So we don't really know. And the same is true in the US. So when we compare the numbers to the US, we kind of see the same thing. People have a lot of rollover debt. At the same time, they have a lot of liquidity. And in order to figure out whether people are liquidity constraints, and that's explaining kind of the mechanism behind the high marginal propensity to consume out of something like a fiscal stimulus payments, then we have a bit of a, you know, it seems like there's a bit of a judgment call needed. Excellent. What we also find is just that average liquidity holdings seem to be pretty high in our data. So for example, when we look at one of these models, which is by Greg Kaplan and Violante, so in those models, people basically hit their liquidity constraint all the time, and that explains kind of the high marginal propensity to consume out of something like a transitory income inflow from a fiscal stimulus payments. Perfect. So the conclusion so far is like a little bit, well, we don't see people, you know, hitting their liquidity constraints in the sense of their credit limit or bunching at zero, but obviously, you know, people may still feel liquidity constraint because they know the liquidity constraint is somewhere out there, but they want to kind of keep a buffer until then. And the question is really like, how can we possibly measure that? Do we have to you know, just make an ad hoc statement like if people have rollover debt, then they are liquidity constrained? But that's not quite true, because you can write down a model, you know, where there's borrowing at high interest rates, and all of that is optimal and no liquidity constraint inside. Perfect. So our idea was to not look at the marginal propensity to spend out of like an income inflow, but rather to look at the marginal propensity to hold on to cash or to hold on to liquid wealth. And in principle, when you think of like a standard consumption savings model, then the marginal propensity to hold on to cash is always going to be 1 minus the marginal propensity to spend. The marginal propensity to spend is decreasing in standard models, and that means the marginal propensity to hold on to cash is increasing in something like income or liquidity. Now, if you add like an illiquid savings device to that model, then that breaks down this relationship between the marginal propensity to hold on to cash and the marginal propensity to consume. And then the marginal propensity to hold on to cash may be either increasing or decreasing, because the marginal propensity to save illiquidly, that is increasing. Now, at the same time, the marginal propensity to hold on to cash is always really low in these models because there's no real benefit of holding cash when you also have this illiquid savings device, which is kind of paying a lot higher return. Now, we decided to modify that model to give people more reason to hold on to cash. And the way we did that is just we assumed that people have like a future liquidity constraint that binds really often. So they really worry about this future liquidity constraint, and that's why they take a lot of cash into the next period. So this is what we see in the data, right? That people have a lot of cash or liquidity. So they seem to worry about this future liquidity constraint. And it turns out that then the model makes a new prediction about the marginal propensity to hold on to cash, and the prediction is that it's decreasing in liquidity or income, same as the marginal propensity to consume. And this is something we can go out and test, right? So we can test whether we live in this world where the marginal propensity to hold on to cash is decreasing, which would indicate that these people worry a lot about the future liquidity constraints. So there would be some type of soft liquidity constraint, some kind of feeling liquidity constraint that the buffer is not large enough. So when we look at that, however, we find that the marginal propensity to hold on to cash looks more like the first model. So it seems to be increasing in liquidity. And note that we do this here at the very high frequency level. And now you may wonder, well, but you don't buy cars and houses, at the high frequency. So you don't, but you buy like bulk consumption goods at the high frequency, right? When you make a decision, do I buy, the ketchup in bulk or not, right? Then you kind of understand that the bulk ketchup has like a much higher return, but you're not going to have the cash available because you invested it all in ketchup. So that's the high frequency intuition here. And anyway, what we find is that idea of us to detect, so to say, whether people worry about the future liquidity constraint, that doesn't seem to be present in our data. And then we also found like another interesting piece of evidence when we looked at this more closely. So in Iceland, you can decrease your overdraft limits quite easily. To increase it, you have to call your bank. And what we find is that the more liquidity constrained people, they tend to decrease their overdraft limits around their paydays, which is something the high liquidity people don't do. So it seems like that our people seem to really want to make themselves more liquidity constraints rather than being liquidity constrained because of the bank is not giving them credit because they cannot collateralize their illiquid savings or future expected income. So that is the one last interesting piece of evidence. Okay, so I'm gonna conclude. So we think that these payday responses tell us something about people, how people think about like spending and money. It's important to understand the mechanism behind it. Is it like some, you get your paycheck and then you go out and splurge type of psychology, or is it like actually liquidity constraint? Because we think that we can understand why fiscal stimulus is like an effective policy measure at the same time. Question is, how can we measure liquidity constraint when we see people having a lot of liquidity and we know, they may have like want to hold like some buffer until they hit their liquidity constraint. And we want to just know how much of the payday responses are driven by liquidity constraint versus not. Excellent. So I'm done.
Thank you, Michaela. We will now have Peter Ganong present How Does Unemployment Affect Consumer Spending? Peter is an assistant professor of economics at the Harris School. I think theoretically, you need to click forward a little. Theoretically, there we go.
So this is really bad news because I have like 100 backup slides. So at the end of this talk, we're gonna have to. Anyway, thank you so much for giving me the chance to talk today. This is a paper also very much in the same spirit as Michaela's paper about how people's spending changes at a high frequency in response to changes in their income. It's joint with Pascal Noel. Pascal's was a graduate student with me at Harvard. He's on the job market now. If you've received his job application and haven't decided to interview him, you still have a chance. He's so the question that I'm going to tell you about today is, how does spending change over the course of an unemployment spell? And the way that we're going to answer this question is using data from people who have bank accounts with JP Morgan Chase, and checking accounts, and they get direct deposit of UI benefits into their accounts. So the paper has 2 parts, and those 2 parts are going to correspond to the 2 parts of my talk today. First, what I'm going to do is I'm going to trace out how does spending evolve month by month for a family where there's a job seeker who's receiving unemployment benefits. And then second, think about what models of the world are consistent with what we see in the spending data. And in particular, that's going to teach us some lessons about the consumption smoothing gains from additional UI benefits. And if we were to make UI benefits more generous, what would be the best way to do that? Or if we were to make UI benefits less generous, what would be the worst way to go about that? So the core of our data, I'm going to go through quickly because it's pretty similar to what Michaela described. So instead of using a financial tech app, we're using data from people's bank accounts, and we've aggregated it here to the monthly level. So it's a little bit different than the daily example that she used. We have data, our data start in 2012, and it's a relatively recent sample period. We're going to focus on people who are eligible for 6 months of benefits or fewer, and that time of when sort of only 6 months of benefits or fewer were available starts in January 2014. So the goal of this paper is not to learn about the UI extensions in the Great Recession. That would be interesting for a future paper. This is just to understand the spending behavior of a typical UI recipient. An issue that always comes up for checking account data but doesn't come up for something like, say, Mint or an Icelandic equivalent to Mint is that some households have bank accounts at multiple banks. And so at least when you present this paper to a room full of PhD economists, everyone says, yeah, I have 3 checking accounts, I have 2 credit cards, so on and so forth. So I don't know how many bank accounts the folks in this room have, but that's actually not very typical of US households. So only about a quarter of US households have bank accounts at multiple institutions. And the way that we try to deal with this is we try to find people whose primary bank account is with Chase. And the way we do it in practice is we look for people who have 5 outflows every month. So you can have income that's high or low, bouncing around, but people who are essentially consistently using this account for their family's transactions. The other piece of that is that some people have multiple accounts, but they have them all within Chase, and we see de-identified data, but before we see the data, we have linked together all of a family's bank accounts. So I'm going to show you one picture of what does a family's bank account look like 3 months before an unemployment spell begins. So for our sample, the 3 green bars that you see on the far left are spending on debit cards, cash withdrawals at the bank, and payments on utility bills like an electric bill or a cable bill. And the focus of my talk today is going to be those 3 bars on the left. And the reason for that is these are all types of spending where there's a direct link in time between making the payment and getting at least some of the consumption benefit. In contrast, the next 3 yellow bars are payments on a Chase credit card, payments on a non-Chase credit card, payments on auto loans or a mortgage. All of those, when you stop making your mortgage payment, you don't immediately lose the ability to live in your house. And so there's less of a tight link between when you make the payment and when you get the consumption benefit. There's some payments that we're not able to categorize. Unfortunately, unlike Iceland, there's a little bit more noise. So the sort of last 20% is things like paper checks, where we know that you made a payment, and we know the amount, but we don't know what the payment was for, and if you were paying a house cleaner, or if you're moving money between different bank accounts, or giving any other service. The final purple category on the far right that you'll see is what we call saving. And so we're defining saving as payments to a Vanguard account, to a money market account, to a Fidelity account. We see you transferring money out, and we don't see all of your accounts, but what we have from this picture is a good view of your day-to-day household spending on immediate needs. So having told you that we sort of have a good picture of the households that are in our sample, the natural question that arises is, okay, but who are the households who bank with Chase? Is this going to teach us about the behavior of people who are unemployed more generally? And as best as we can tell, the answer seems to be yes. So in the paper, we compare the people in our sample to external benchmarks in terms of family income, the distribution of age, checking account balances, spending on categories where we can see something comparable in our data and in the consumer expenditure survey. And in all of these dimensions, the people in our data look pretty similar to the external benchmarks. One important piece of context here for why this is the case is that to be eligible for UI benefits in the US, you need to have worked for usually 4 of the 5 prior quarters. And so what that means is that this is not a good data set for studying people who are in serious poverty and are bouncing in and out of the labor force. But for someone who was working for 4 of the 5 prior quarters, those households typically have bank accounts. They typically get paychecks paid to their bank accounts. And so it's not surprising, given the eligibility rules, that someone with a checking account does a good job of representing a UI recipient. So there's basically one picture which can summarize the entire talk, and hopefully when you walk out of this room, you'll remember this picture if you don't remember anything else. And so what this picture shows you is the evolution of spending over time for someone who stays unemployed for 7 months. So the first vertical bar on the left is the onset of unemployment, and there's a sharp, discrete drop immediately at the onset of unemployment. Then, while receiving UI, spending falls a little bit with each additional month until finally, at the end of a UI spell, in that last month, we see a very sharp drop in spending of around 11%. And this is just spending on those green bars that I showed you before. Spending on non-durable goods and services is falling by 11% in the month that UI benefits run out. So the next thing that I want to do is I want to dig into this plot with to answer 2 different questions. And this the questions that I've written on the slide. The first is, why does spending drop at the start of unemployment? And the second is, what exactly is happening and why is spending dropping when UI benefits run out? Okay, so the first thing that we do is we take our sample and we divide it into states with high UI benefits and states with low UI benefits. And what you can see is that the pre-trends for these 2 groups are very similar. The month when job loss has occurred, so it takes about a month between when you when you lose your job and file for UI and when you start getting UI benefits. And so spending is the same in high and low benefit states before the UI check shows up. And after the UI check shows up, the 2 series diverge. People spend more in states while they're unemployed, in states where UI benefits are higher, but only after the check has arrived. And so this kind of behavior is sort of like what Michaela documented, that people are only spending when their UI check arrives, much as they were only spending 20 minutes ago when their paycheck arrives. So the fact that people's income is lower and that their spending is responding exactly when the UI check arrives suggests to us that UI is playing an important role in stabilizing their spending while they're unemployed. So the second fact that I want to show you has to do with benefit exhaustion. And here we have the advantage of having some states which have decided to change the duration of their UI benefits. So since the recession, the state that's made the most draconian cuts in the level of UI benefits and in the duration of UI benefits is Florida. And so what this plot traces out for you is, for people who get UI benefits for at least 14 weeks, what does their spending look like in Florida versus what does their spending look like in other states? And what you can just see visually reading off the plot is that consumption smoothing in Florida is much worse than consumption smoothing in these states which offer 26 weeks of benefits. The other thing that jumps out if you look closely is that the time when spending drops is the time when benefits disappear. So there's a discrete drop in spending exactly in the month that UI benefits disappear. So it's not that after 6 months employers start discriminating or after 6 months your family stops helping you out. There's a direct link between when your UI benefits run out and when your family cuts your spending. A natural question to think about is, okay, people are cutting their spending. What are they cutting? What gets cut most? So we see spending at drugstores dropping a lot. That's a mix of, buying Kleenex at CVS and buying stuff at the pharmacy at CVS. We see medical copayments dropping a lot. We see groceries dropping a lot, and we see things like movie tickets dropping a lot. So these are all, the last two in particular, are highly non-durable categories. When you spend the money, for the most part, is when you get the benefit. And so we think it's not just that people's spending is dropping when their UI benefits run out, but that also that their consumption or their well-being is actually changed between the month before benefits run out and the month that after benefits run out. Now, on the flip side, the type of consumer categories that have the smallest drop in spending tend to be financial commitments. So people, in relative terms, keep paying their auto loans, keep paying their mortgages, keep making their insurance payments. We don't see a big increase in delinquency in credit bureau records. And so the way that we think about this is that people are cutting back on their day-to-day consumption needs in order to, as best as they can, protect their financial commitments. So that wraps up the empirics half of the talk, and now I'm going to spend a little bit of time talking about sort of different economic models, but I promise to do it entirely in pictures, and hopefully it'll be fairly easy to interpret. So what this picture shows you is what the prediction you would get out of a standard, rational, forward-looking buffer stock model, sort of the benchmark model, for an agent who loses her job. And she's going to cut her spending when she loses her job because losing your job is bad news. Now, each additional month of unemployment is more bad news. And so the sort of rational model says that an agent who has lost her job should cut her spending a little bit each additional month, such that benefit exhaustion is nothing special. It's unfortunate for benefits to run out, but it's something that the rational model says you should have prepared for. And sort of as you already know, because you've seen this and you're going to keep seeing this line again, that's not exactly what we see in the data. We see people not preparing enough for benefit exhaustion and then cutting their spending sharply right when benefits run out. So we have spent a lot of time trying to sort of torture this rational model into delivering something that is consistent with the spending series. And we basically have not been able to torture it to do that. And the intuition for why it's hard to torture a rational model to get a sharp drop at exhaustion is benefit exhaustion is predictable. You know when you start receiving benefits how long your benefits last. And it's really bad. If you don't have money in your bank account, it's a really substantial, significant economic risk for your benefits to run out. And so basically any version of the rational model says that you will prepare for it. So the last thing that we do in the paper is we look at behavioral models that might do a better job of fitting the spending data. So there's a recent paper by someone named Xavier Gabex. He has a model of the world where people don't fully perceive their future risks about the world. So they don't pay enough attention to interest rates, they don't pay enough attention to income. And he has a model where at one end, people are totally rational. He's going to call that M, the M number M is 1. And at the other end, people are totally myopic. They're not forward-looking at all. And sort of the number between 0 and 1 indexes how people are behaving. And so we think about a world where people are not fully aware of just how much income they stand to lose when UI benefits run out. And they don't have to literally not know the number. They can also set their spending as if they are not paying attention to that risk. And so the sort of number that we come out with that you can see on the top and the subtitle of the slide is 0.71. So if you're trying to index the world between myopia and full rationality, you come out that people are mostly rational but not totally rational. A second model of the world, which is able to sort of generate the spending patterns that we see in the data, is a paper by John Campbell's one of the people on the CFPB advisory board that he wrote over 20 years ago, where he said, maybe some people have behavior where they're hand to mouth. They only spend they spend whatever comes into their bank account every month. And so a model where some people are hand to mouth is able to also fit these patterns. The last piece of the paper that I want to mention is that we use these models to think about what are the benefits to raise, what are the gains to raising UI benefits. And there's two different ways you could think about changing UI benefits. You could think about raising the level of UI benefits that are paid each month, or you could think about making UI benefits last longer. And what emerges from that comparison is that it's much more valuable to make UI benefits last longer than it is to increase the level of UI benefits. And the intuition for why that happens is just the plot that you saw before. Because spending falls a lot at benefit exhaustion, it is more valuable to help people in their sort of worst state than it is to help people while they're receiving a UI check where they're in a bad state but not a terrible state. So that conclusion holds across all of these different models, and the behavioral models basically provide additional impetus for thinking that UI extensions are good at helping people smooth out their financial lives. I think I have 2 minutes left, is that right? Great. So for the last 2 minutes, I just wanted to briefly sort of ask some questions that I'd love to hear your thoughts on later about how does a talk about unemployment apply to the work of the CFPB. So I think one thing that we see from the behavior of people who are unemployed is that they're not preparing for the bad event, the bad case of benefit exhaustion. And I think there's a more general question here, which is how do we teach people to prepare for bad events in their financial lives? And I don't know if that's disclosure. I don't know if that's defaults. I don't know if that's counseling. In my mind, it's an open question. I would love to talk more about how we help people prepare for these risks, but the unemployment evidence suggests that it's really important to think about what's the best way to do that, and that's something that CFPB is particularly well poised to be able to look at because of its ability to do surveys and lab tests and all of that. The second point has to do with the payday rule. So in this paper, I've shown you people don't spend as if they think exhaustion is going to happen. And if you sort of think about the motivation that Director Cordray used for the payday rule, he sort of had this analogy of a taxi ride which then takes you across the country. That you expect to only pay for a short amount, repay immediately, but in fact, it never comes out that way. And so I think that basically there's an analogy here, which is that people's expectations don't seem aligned with what happens in a systematic way. And when there's a time when people's expectations doesn't necessarily align with what happens systematically, that creates an opportunity to basically help consumers and improve welfare. So just to wrap up, I've shown you hopefully 2 new facts about what happens to spending during unemployment. So spending is very sensitive to the level of UI benefits. Spending drops sharply at UI benefit exhaustion. And the fact about benefit exhaustion has important consequences. So it's not consistent with a model of rational behavior. It is consistent with some different behavioral models that we talked about. And it also implies that the gains from extending UI benefits are larger than the same amount of gains from raising UI benefits. So thank you very much. All right, that was the awkward. If there's anyone at the back who can control the slides, feel free to accelerate this.
All right, well, while Peter gets that, I will thank him and also introduce the next speaker. The next paper will be presented by Ulf von Lilienfeld. Ulf is a professor at the Luxembourg School of Finance, and he'll be presenting his paper, Identifying the Benefits from Home Ownership, a Swedish Experiment, just as soon as we can reach his slides.
I'm not even pushing the button, it's just going at this point. Does someone There we go. Excellent.
Perfect timing.
Well, thank you for putting my paper on this fantastic conference. I'm the last guy, and this is with my 3 co-authors, Paolo, Stein, and Reune. And what we want to answer is the question, how does your life evolve if you sort of own your apartment or rent your apartment? Now I found out this pointer. This is the when I checked excuse me, when I checked earlier we had like 20 slides.
You have to talk twice as fast.
Give me 1 second.
corresponding either, right? Because the hyperbolic discounting there, he's just going to extract that. Yeah, so it's also going to be more steep, right?
Tempting.
Yeah.
Dancing.
I mean, I think that, it seems like all of this spending and all, it just seems like not consistent with any rational model.
Yeah, but the question is how big is the failure?
But the problem is like, so when you, there was the how big is a failure thing, like when you, so you show that the rational model doesn't work, but then you use that same model to make welfare predictions.
Right, but some people prefer it. I
No,
mean, that's
I
why you use,
understand.
like, there's 3 rows. There's
Wait, but like
models
I'm
that
just
fit and
saying,
models
like,
that don't fit.
right? If you just show that the rational model doesn't explain like what you see in the data.
Okay, I do whatever I have.
then people show that the welfare implications of that are
This is
valid.
20. Okay, so we just saved, we lost 1 minute by me going back and gained 15 minutes by having a faster presentation. Okay, so I'm still the last one. But this is much easier for me to sort of. So the reason why we want to understand how lives change is that there are many countries subsidizing home ownership. For example, in the US, it's $20 billion per year. And at the same time, costs and benefits of home ownership is poorly understood. And this is mainly due to two problems. One is measurement, and the second and tougher problem is identification. Identification because tenure status is endogenous, so if you're a tenure track assistant professor, you're less likely to buy a house than if you're a tenured professor, for example. I've seen both, and building status is endogenous, so typically owner-occupied houses are in nicer neighborhoods. And because it's such it's funny, in medicine, if it's an important question, you really need sort of clean experiments, and in economics and finance, we seem to say because it's such an important question, we don't have field experiments. So there are no field experiments on this. So what we do is we sort of revert back to a natural experiment in Sweden. It's a nice travel, so we started with Iceland, went to the US, and now we're back to Sweden. And time-wise, we sort of started daily, went monthly, and I'm going to do it yearly. So what we do is we look at the privatization of municipally owned multifamily housing, and this is sort of similar privatizations went on in Germany or the UK. In the UK, it's still debated, and we're going to look at the impact of home ownership on household behavior. And we have high-quality tax authority data, so we do have sort of the full-fledged population, and we're going to look at a policy, so to say, which is sort of a home ownership windfall gain effect, because we are interested in policies promoting home ownership, and this sort of naturally is going to involve some windfall gain. What are the results we have? The first result is very reassuring that our experiment indeed leads to higher home ownership. So the first stage is meaningful. People who are sort of treated as homeowners own more homes in the end. And then the economic effect is quite subtle, and it does sort of, those of you who like the rational models, there's some aspects supporting the rational models, and so those of you who like behavioral models, there's also something for behavioral models. So the main results we have is that home ownership does not seem to affect family stability. So people who are homeowners don't have more kids, they don't marry more. However, we see, and this is very similar to sort of the two papers we had, or in particular Peter's, the consumption goes down when you buy a house, and savings goes up when you buy a house, but only in the year you buy. So it's a very short-term effect. Okay, people don't seem to smooth out, so there's not much evidence for smoothing out. We do see that labor income goes up and labor force participation goes up, which sort of speaks in favor of a debt service effect. We have a very strong collateral effect. So if we look at renters, it's similar to what Peter finds. They seem to be smoothing consumption very little. But if you have collateral and you own your apartment, we actually see that there's a very strong consumption smoothing going on for homeowners. Finally, there's results on consumption. There's been a lot of discussion in the US whether people eat out of their home equity, and we do find this, but only if you move out of your house. So it seems that our Swedish population in the 2000s was very sort of peculiar. They didn't look at their book profits. They only sort of thought, oh, now I'm rich after they sold the house. They don't seem to sort of save out of profits they haven't realized. Okay, it's a little bit complicated, so I have to take you through a little travel through time. So we're sort of moving back to 2000 in Stockholm. And in Stockholm, about 1/3 of all apartments were municipally owned. Okay, so these were owned by 3 municipal landlords, roughly 100,000 apartments. And if you, sort of the other 2/3 were owned by private landlords. And if you are a private landlord, your rent setting is regulated. And rents are indexed to the rents of the municipal landlord. So if you have a nice 2-bedroom apartment with a view of the water in Stockholm, there is a lot of water in Stockholm, you could say, well, I want to charge $1,000 because the municipal landlord next door, who also has a 2-bedroom apartment with the view of the water, also charges $1,000. Okay? So that's how the rent is set. And then there was a mass privatization in the early 2000s when a center-right coalition, center-right in Sweden at the time, I don't know what that is, but sort of center-right coalition came to power, and they sort of started a mass privatization with about 12,000 municipal apartments being sort of changing hands. And then in particular in 2002 there was a law which added a layer of approval, a layer of complexity, where in the privatization process. So how does a privatization go about? Tenants, those who live in a certain building, need to build a co-op. Not everyone, but at least 4. And then they register this co-op. And as a co-op, they're going to apply with their landlord and say, look, we really want to be homeowners. Okay? Then the landlord is going to do some appraisal and is going to set an asking price. And say this is what you can buy the entire house for, and then the co-op develops an economic plan where they sort of say how much, how they're going to finance it, and there's going to be a vote by tenants, and at least 2/3 of the tenants need to say yes, we want to participate in this conversion, and then it can go, and the contract can be signed. And then in 2002 there was this additional sort of layer of complexity which is based on this rent comparison. Recall this 2-bedroom apartment. Now the county board has to say, well, there is enough 2-bedrooms apartments in a municipal landlord so that we can actually fix the rent for private landlords. So that's the driving force behind the county board's decision. And we argue there's a lot of randomness in this decision. And as an example, I'm going to show you what's called the Akala complex. And you see there are 4 co-ops, 2 in red and 2 in blue. And these 4 co-ops have 4 high-rising houses. So this is the map. And the high-rise, these are the high-rising houses, and there's sort of the vast majority of apartments. And then you have these little houses here. These are inner court townhouses, and these inner court townhouses caused a problem. Because the county board had to decide on all 4 cases in the same meeting, and the problem was the county board asked the question, well. Are there enough comparable apartments or houses to set the rent? And they said, well, there are not so many inner courtyard townhouses, so we cannot privatize all 4. We can only privatize 2. Now the problem that occurred is that there's no established procedure how to go from 4 to 2, so the county board decided to go with the date of the vote. Okay? And the vote was sort of here, 21st of April 2002 versus 17th of June and 19th of June 2002. It could have also gone by the appraisal date or by the vote share. And any of these other rules would have led to a different outcome. So that's sort of one example of where the randomness is coming from. So this sort of gives us hope that we find some random assignment of home ownership. The windfall comes from the fact that these tenants, they can always sort of continue to rent. So you need to sort of offer something to the tenants. And as a result, the asking price, the asking price is the net present value of the regulated rent minus the expenses. Okay? So there is a discount, and the discount is the co-op market value, the value of the share in this co-op. That's the value of the apartment you're going to buy compared to the asking price. And that's the difference between sort of the value of the apartment on the open market and the income you generate with the regulated rents. And this windfall is fairly large. It's 700,000 kroner per household, or 500,000 kroner per adult equivalent, and that's sort of roughly $50,000. So this one sort of would suggest it's fairly large, but there's also a nice sort of implication of this. There are no cash flow implications. Okay, so if you buy or you rent, if you don't move out, your cash flows are not going to change because the ask price is set by the regulated rent. There's also no borrowing constraints because the banks are willing to finance this 100%. Now, we have 4 different data sources. The county board, which gives us all the decisions. We have the archives of the municipal landlords. We have the co-ops for residual tenants. Residual tenants are those that did not buy their apartment. And then we have Statistics Sweden on all sorts of individual level information. So we have information on income, on wealth, on education, on family composition, and so on. And in particular, this allows us to generate sort of a measure of consumption expenditure, building on sort of earlier work of my co-authors, where consumption is income minus saving, and we have a very good measure of this. Sort of to convince you that this is sort of randomly assigned, this is a map of the co-ops we're looking at. In total, we look at 38 co-ops. Red ones are the ones which were not allowed to privatize, and green ones are the ones that were allowed to go. And here, these two, that's the Akala, there's sort of 2 red dots hidden. Okay, in total, we have 2,500 households. We have 500 households in the treatment group, and more than 10,000 household year observations. And one issue we have to solve is the treatment year. When do you become homeowner? For those that become homeowner, that's easy. That's when you actually get the house. But if you don't get a house, we take the county board denial date. Okay. We have 2 ways of following households. One is that we dynamically track all households. And in particular, if 2 singles marry, I have a child, this household is dropped and gets a new identifier, a new treatment identifier, and the fixed household, the household is dropped completely. For the identification, it's a standard diff and diff identification with sort of dynamic treatment effects. So we have the treatment group convert, and then the relative year dummies. And this is the relative year dummies for the control group, and we include building fixed effects and year fixed effects. Okay. Now, this is the first stage. What's the impact of our experiment on home ownership? You see that sort of nobody owned, or hardly anyone owned a house. You may have a summer house, so that's why it's not 0. And then it jumps up dramatically for the treatment group, but not for the control group. There's no effect on marriage, on divorce, so we focus on the fixed sample. Now, the first interesting result is consumption. And we see that consumption drops in the year of treatment. Okay, this is the year of treatment, but not in the years to come. And this is mirrored in the savings. You save a lot in the year of treatment, in the year you buy an apartment, but you don't save afterwards. Okay? Now, there is sort of an alleged cost to home ownership that you may consume out of your home equity. And as I said, we do observe this. That's here. But it's only for those that move. So only if you realize your profits, you do consume more. This is the change in debt. Obviously, you increase your debt in year 0, and now it's for those that do not move. They actually repay their debt. So if you stay in your house, you are working off your debt over time. Now I want to come to the last point, the collateral effect, and this is sort of highly related to Peter's paper. What people think and what sort of may be a potentially beneficial effect of home ownership is that it allows you to smooth a negative income shock. The question we want to answer is, do homeowners and renters respond differentially to a similar income shock? So do homeowners use their debt capacity to smooth consumption, which is typically a difficult question because home ownership is endogenous, and we use our setting to answer this question. We have a dummy variable, which is going to be 1 if the household labor income drops by 25%. Okay? So this we view as a large shock in income. And if your income drops by 25%, we can check whether, how this relates to home ownership. And we do this by, again, having our standard setting. That's sort of this one. This is the relative treatment effects for the treated. And this is the relative year effect for the control group. That's what we had earlier. And now we interacted with a dummy for an income shock. And it turns out that owners respond very different to the income shock than renters. Okay, so owners have a 32,000 higher consumption due to an income shock than renters. So this is almost the entire income shock is absorbed by the debt capacity. Okay? And this also tells you that the post-privatization consumption responses of stayers is largely driven by people who get an income shock. So this makes me conclude. We look at the economic benefits of home ownership, and we use a natural experiment in Sweden. And we find that as long as the home equity gains are not realized, effects on consumption are small. So it seems that people don't like to consume out of their book profits. They want to have sort of cash in. If they cash in, there's a significant consumption response. At the same time, households can weather a negative income shock, and savings increase due to home ownership, and homeowners seem to have a higher risky share, which I didn't present here. Overall, home equity seems to promote harder work, mobility, consumption expenditures, and a higher stock market participation. And we have a new evidence for the housing collateral channel. And obviously, this is hopefully not the last paper on this reform, where we're going to look at neighborhood effects. Okay, thank you.
Let's see. Do you have slides? Can we get back to the wherever we're supposed to be in the slides? The irony is that of the 3 presenters, Ulf was the only one who checked on his slides before the panel started. So I want to thank all of our paper presenters. We are now going to have discussion from Jeremy Tobacman. He is a visiting scholar at the CFPB in the Office of Research. After Jeremy's discussion, we will open it up to questions from the audience. You'll have your slides momentarily.
So
It's a pleasure to be here and to be discussing these papers. I tallied the total number of pages in these 3 papers, and there were 209. So rather than taking 3 seconds per page to go through specifics, I thought that my few minutes would be better spent describing some commonalities, some differences, some highlights, and some open questions. So that's my game plan. Now, okay. And as a visiting scholar, I think I'm the first one today to express the disclaimer that the views are just mine, and they're not those of the Bureau, of the Director, or the United States government. Okay, I think that's I think that covers it. So. The similarities that I'd like to go over quickly are first involve the common theme of the papers, which is about the dynamics of household balance sheets. And this is one of the 2 priority areas for the Office of Research at the Bureau. I think it's worth highlighting this because this research agenda involves the combination of data sources that cover savings, consumption, borrowing, and income, and tries to understand systematically how all of these fit together, and helps us then also hopefully to be able to characterize these patterns more. It also is useful, I think, in saying this to point out the clear fact that that these papers are not about any specific product. They instead are about the balance sheet broadly, and this is interesting as a sort of point of basic science for the Bureau. In terms of what the papers do, you can think of them as estimating treatment effects. And here I wanted to sort of characterize what they are, and then talk about some differences in how they approach this. But so the Olofsson and Pagel paper you can think of as calculating something like the derivative of consumption with respect to an indicator for whether payday is arriving. Peter and Pascal are studying the change in consumption with respect to to net take-home pay, whether that's the removal of labor income or the arrival and then subsequent disappearance of UI. And then Ulf's paper, I think it's fair to say, is able with the amazing Swedish administrative data to study the derivative of sort of everything with respect to this indicator for home ownership, and also with respect to wealth, because there's this inextricable linkage in his analysis between the transfer of the apartment and the arrival of the large wealth shocks. So one of the other commonalities, so that these, when we look at these, among everything is included consumption. So here we are looking at consumption responses broadly, and there are different purposes, which I'm going to come to in a moment for the analysis that they're undertaking. So the administrative data sources here, and another commonality, are really quite high quality, both in the extent of the variables and the way that the papers handle the data. And this actually involves a non-trivial lift in each of these cases, because the consumption data are not measured directly with something like the consumer expenditure survey questions. How much did you spend over the last 3 months on your various different types of utilities? How much did you spend on groceries? How much did you spend on all of these items? Instead, they have to construct these measures in Peter's case from the categories and of consumption that are labeled by J.P. Morgan Chase, and I think that there was a big lift that Peter and his co-author did to label some of these data based on merchant names and codes. Likewise, in Michaela's data, they have very high quality consumption information now, but this is rare, and it's because of careful work to operationalize the information on the merchants. And in Ulf's data, consumption is not measured directly at all. Instead, they're using the dynamic information about changes in the balance sheets along with income data in order to impute consumption. So in all of these cases, consumption is sort of what we want because we think that that's what connects most directly to the consumer benefits, consumer well-being, and has the sharpest connections with theory. But it's not there for the taking. Instead, it requires a great amount of work, which these authors have undertaken. Okay, so so also, I think it's worth indicating that the breadth of a data set is not the same thing as the depth of a data set. And in the case of the JP Morgan Chase data, in principle, huge numbers of observations are available, even when studying relatively rare events, thankfully rare events like unemployment spells. There are lots of observations that can be studied. In Sweden, the variation is really at the co-op level, and there are only 38 of these. So that project relies on excellent data on a much smaller number of people and variation across fewer observations. Okay. Another important difference, and I think Ulf mentioned this already, is the time horizons. And I say that this is actually important because otherwise we just feel like we're studying how consumption or how proportional changes in consumption arise relative to these other shocks. But actually, I think that one challenge that we as a profession have, and that the Bureau, as far as I have understood it, wants to get a better handle on, is how the high frequency connects with the low frequency events. And there are a lot of different reasons for this, for, I think, general interest in this topic. The types of products that are going to matter for people at very long horizons are different than the ones that may matter at short horizons. And we have new capability to study the high frequency activities, and we want to be able to connect our understanding at both this range of frequencies. When previously many analysts have looked at the effects of predictable changes in income on consumption, oftentimes they've done this to try to study fiscal multipliers and make comments about optimal fiscal policy. And I think that the economics profession is really interested by the types of results that Michaela shared and that have been shared in the Gelman et al. Science paper on very high frequency responses. But we're still trying to sort of think about the connection between this high frequency responsiveness in the household balance, household cash flows, and the low frequency work that's yet to come. Yue Zhang has also done some work in this, some excellent work in this area. So the findings, I think, share some commonalities and some differences. And I want to try to bring these together to at least put some numbers on the screen and talk about how they relate. So the central Olafsson and Pagel results are on the order of the change in consumption with the arrival of a paycheck being about half of daily average consumption. So this sounds big, and it is big relative to the daily baseline, but as a marginal propensity to consume, it's very small because you want to divide by the number of days in the pay cycle. So most of the households in her data set are paid monthly, so the marginal propensity to consume out of these out of the paycheck arrival is more on the order of 2% rather than 50%. So I think that that's an interesting, that both of these numbers are interesting. The fact that there's any response, especially for the high liquidity households, challenges our preconceptions about how consumption decision making proceeds. But we also want to be able to reconcile the numbers that she's finding with numbers that are calculated in other domains. And the MPC here is relatively low. The Ganong and Noel numbers for the change in log consumption, the proportional change in consumption when unemployment arrives and then when UI runs out, those are on the order of 6 to 11%, and those are more those are not yet MPCs because you have to adjust for the amount of the income and the benefits, but in principle they can be aligned. And then there's this interesting difference that Ulf and his co-authors find that the MPC out of these big wealth shocks seems to differ depending on whether people move out of their homes to a new home versus staying. And the paper argues that the difference is largely because people only access the new home equity when they move. They only extract when they move. But that invites a question: why don't more people who are staying borrow against the home equity? And do we really think that the MPCs are fundamentally different for this, or is there just a selected population that moves out that would have more latent demand for access to cash? So if I think I have time to just sort of share to re-illustrate these main pictures. Pictures are worth 1,000 words. I don't think I'm up to 1,000 yet, but let me put these up and to share it. I think these are the pictures that matter the most to keep in mind for what's going on here. The Olafson and Pagel result shows this large spike relative to average daily consumption when the paycheck arrives, and the vertical axis is not visible but goes up to about 0.6 here, and on the left you have the consumption response for the low liquidity households, on the right for the high liquidity households. So the key surprising finding here is that there is a response for the high liquidity households. The Ganong and Noel result shows this substantial reduction in consumption for people who lose their jobs, and this invites the question: why weren't they doing more precautionary savings ahead of time? Now, that's not a value judgment. That's a question that we just want to understand as it relates to policy and insurance against hardship. And then the Lilienfeld and Toll paper shows these consumption responses across the income distribution, and with substantial variability across the quintiles. So here in my last minute, let me pose a few questions, and these are sort of what I see as collective questions that we should all be interested in going after. The first is, what role for expectations? And in each of these papers, to the extent that people have clearer expectations and more accurate expectations about future events, then the standard models would predict that they would be more likely to smooth consumption. In the case of this has particular implications for the interpretation of some of the findings. In Ulf's paper, if the control group thinks for a while that they're actually going to be getting this big windfall, then they may increase their consumption in the short run and then decrease it after the policy makes it clear that it's not going to go through. So likewise, one of the key factors for interpreting the findings about unemployment, about consumption responses to unemployment, is the individual's expectations about the probability of finding another job and the wage distribution that they expect to find. So I think that that sometimes when there are expectations for particular shocks, we just get attenuation of effects, and sometimes expectations have broader implications, which we should, or other implications that we should investigate more. In terms of the role for models, I think that it's very important to sort of pursue the basic science initiative of understanding decision making in this area, and the authors here are pressing forward to try to understand a variety of neoclassical and non-standard models that could be relevant, and including those for heuristics, and there's this interesting anomaly in the case of the Swedish housing privatization, where 20% of households don't take up this enormous gift. So that's a puzzle which I think is as interesting as many of the other things that are pursued in the paper. And then I think that, as I alluded to before, how we reconcile the short-term and long-term effects is important important for systematizing or understanding the models and applying these results in other contexts. So I think it's an excellent collection of papers, and I'm very happy to get a chance to think about them hard. Thanks.
Thank you, Jeremy. We now have time for questions. We're running a little bit behind, but Ron, are we taking time from the poster session, or are we taking time from the questions? 3 minutes. 3 minutes, all right. All right. We've got time for 2 questions. We've got a couple of CFPB staffers circulating with microphones, so if you can please talk into the microphone and say your name and affiliation, that'd be great.
I'm Ian Ayres from Yale Law School. Peter, is your result that it's better to increase the length of unemployment benefits than the per period size of the benefits? Does that hold up if we allow the length of unemployment spells to vary? I'm thinking both because if you increase the length of the benefits beyond the average expected unemployment spell, most of the people aren't going to be getting those benefits. And secondly, is your myopia effect suggest that people might start looking harder for a job once their unemployment benefits run out?
If you push that. Sure. If I push it.
Oh, no, you don't have to push it.
We're all good to go. It continues to hold if you take into account the fact that raising UI benefits discourages job search, extending UI benefits discourages job search at the sort of consensus estimate. If people were only sensitive to duration and weren't sensitive to the level, it might be a different story. But sort of at the consensus estimates in the literature, it does hold.
Other questions? All right, we've got one back there.
Hi, this is Jessica Russell, CFPB. Another question for Peter. I was curious if you did any looking at people who had experienced unemployment for multiple periods and if they were better the second time around at predicting.
So I think all 3 of my PhD advisors independently had that recommendation, and they're all Harvard professors. So it's a good question. The data aren't the data aren't. It's just too short. We have like less than 3 years of data. So in the future, we'd like to look at that.
We have 1 minute. If there's another quick question, anywhere in the room?
So Steve Laufer from the Federal Reserve Board. Also a question for Peter. Sorry, I'm a labor economist. This relates to a earlier question, which is that we know that people who are on UI are much more likely to find a job right when those UI benefits expire. So I wonder if it's not just a failure to anticipate the decline in benefits, but if there's an expectation that people will get a job once their UI benefits expire, and that the fact that they don't may be a second shock. I wonder if that would be consistent.
So 2 answers to 2 pieces. So what you said about people being more likely to find a job when they leave UI is qualitatively correct, but actually quite small. So it looks like about 25% of UI recipients find a job each month. In the month that UI benefits run out, the sort of best research from Austria, which sort of like Michaela has very high frequency data, shows that 30% of people find a job. So the effect is there, but it's not large. Taking that effect into account doesn't change the results.
All right, thank you for your questions. I want to thank the panelists again, if we can all give them a round of applause. Next, we have a break and poster session. We'll be back for the next panel session at 3:50. Thank you.